Hi, I'm Rob. Welcome to my second stock analysis video. My first video was on Greencoat UK Wind. Today we're looking at a very similar company called the Renewable Infrastructure Group, also known as TRIG. First is an overview of the company. As the name suggests, they're an infrastructure trust that focuses on renewable energy sources like wind and solar. They are mainly based in the UK but do have some assets in Western Europe. They currently have a total shareholder return of 9.3% a year since IPO. They currently have a portfolio worth £2.2 billion, to which they continue to invest in each year. They are also in the FTSE 250 index alongside Greencoat UK Wind, with a similar market cap. As mentioned, they continue to invest in their portfolio, by which they follow their investment policy. At least 35% of the portfolio must be based in the UK. This is currently 63%. Non-wind and solar assets can't exceed 20%, and no single project can make up more than 20%. TRIG mostly invests in solar and wind farms which are already in operation, and therefore cap under construction projects at 15%. Lastly, they cap the amount of debt, also known as gearing, that they can take on, with short-term debt capped at 30% and then total gearing capped at 50%. The majority of current gearing is long-term structured debt. TRIG's gearing is up from 36% in 2019 to 43% in 2020, with an average cost of debt of 3.4% a year. TRIG has 3 ESG objectives and 3 financial objectives. For ESG, their assets have annually avoided 1.2 million tonnes of CO2 emissions. They currently have 14 active environmental management projects and spent 1.2 million on community projects in 2020. Financially, their aims are to provide an attractive, long-term and income-based investment with strong management and a large, diversified portfolio. Let's look at TRIG's current portfolio. They currently have 48 wind farms, of which 5 are offshore. They also have 28 solar farms, which only make up around 13% of their total portfolio. As mentioned, most of their projects are based in the UK, with a small percentage in Ireland, France, Sweden and Germany. Their total current capacity is 1,820 megawatts. This portfolio generated 3,653 gigawatt hours in 2020. In 2020, TRIG made 6 new investments. East Anglia 1 is one of the world's largest wind farms and currently makes up 10% of the portfolio on a value basis. East Anglia 1 is made up of 102 7 megawatt turbines. TRIG currently has an equity share of 14.3% of this wind farm. As you can see, TRIG continues to invest hundreds of millions of pounds each year, with 2020 being its biggest year, with £588 million being invested in projects. However, as some projects are currently under construction, they haven't been added to the operating portfolio as of yet. So how has TRIG done in 2020, and how much has the pandemic affected them? They've had their smallest increase in net asset value in 5 years, with a 0.3 pence increase from 2019's 115p to 115.3p. NAV has increased 15% over the past 5 years, with a 3% average a year. TRIG's portfolio generated 1.3% over their budget in 2020. Budget is just another way of saying their estimates for the year. Variations from the budget are mainly caused by varying wind speed from year to year. TRIG has been growing their dividend every year since IPO. It has grown from 6.08p to 6.76p in 2020. This growth represents 11% growth over 9 years, or 1.22% a year. For the first time since their IPO, they have decided not to increase their dividend for 2021, most likely due to the pandemic changing power prices and their forecasts. I'm quite surprised that they have done this. I don't think anyone was expecting a large increase, but no increase is quite a change that wasn't expected. Their dividend cover for 2020 was around 1.2 times. As TRIG pays out a large portion of its profits as dividends, their share price hasn't had any dramatic increases. Companies like TRIG and Greencoat UK Wind share prices are very closely linked to their net asset value. Share price has grown 25.4% over 7 years, representing an increase of 3.63% a year. However, as mentioned, TRIG pays out big dividends, and as a result, shareholders' return for the same period is 74.8%, representing a fairly impressive 10.5% a year. The orange line on the graph shows an estimate in performance if dividends are reinvested back into TRIG once received. So how does the future look for TRIG? Firstly, going back to the portfolio valuation, we can see they have already priced in changes in power price forecasts, with minus £137 million as a result. There are two main reasons for this reduction. Firstly is down to the reduction in economic activity due to the pandemic. Less demand results in lower power prices. There has also been a recent increase in expected build-outs of renewable, increasing supply side of the equation. This is mostly mitigated by increased energy demand over time. As mentioned, there's been a reduction in expected power prices over the next 20 years. As expected, lower power prices decreases TRIG's revenue and vice versa. However, TRIG currently does not have a large exposure to the current market power prices. This is due to most of their revenue being generated on predetermined fixed power prices. This reduces risk caused by decreasing power prices. As you can see, even over the next 9 years to 2030, 74% of their income is fixed power prices. This does not mean fixed revenue. Of course, a portfolio can underperform on the generation side. So if the share price is heavily driven by net asset value, what can affect the NAV? The main factor affecting the net asset value is output. Output is based on predictions for the next 10 years. For example, P50 output is the expected output with 50% chance of being exceeded and also 50% chance of being underachieved. A P90 output is a downside case and has a 90% chance of being exceeded. This would have a large impact of minus 14.3p. On the other hand is P10, which is optimistic and has a 10% chance of being exceeded and would have a 15.3p increase on the net asset value per share. As mentioned earlier, a change in the power prices can affect the NAV. A 10% increase in prices will increase the NAV by 7.6p, and the opposite reduction in prices will have the same negative effects on the net asset value. As most of the project's revenue is amended each year with inflation, and power prices generally follow inflation, it can benefit TRIG. The NAV already has inflation priced in, with UK inflation based at 2.75% and the rest of Europe at 2%. If inflation increases 0.5% to 3.25% and 2.5% for the UK and Europe respectively, the NAV per share will increase by 5.3p. Other factors are less important. For example, interest rate changes has less than a £1 million change to the portfolio value, as TRIG uses long-term structured project debt rather than short-term debt. With a current share price of 128p, this is an 11% premium to the net asset value. This is around the average premium for the past 12 months. Share price has pretty much recovered from the crash in March 2020. So 11% premium is pretty average. I like to think anything under 10% is a buy and above 15% is best to wait. You're very unlikely to get under 5% or even at a discount to the NAV. I do currently own some TRIG and have been since April 2020. However, the majority of my shares were bought in April 2021 at a price of 123p. I can personally see an argument for buying at the current share price, mainly as I don't see the NAV decreasing in 2021. I guess you can make an argument for wanting to buy at a better premium. TRIG share price isn't very volatile, which can be positive as you can take time when making buy or sell decisions, but also a negative in that the price isn't likely to suddenly drop or present a great buying opportunity. Thanks for watching. Please like the video if you enjoyed, and please consider subscribing.